Mike Prus here, founder and chief investment officer of Scale Investment Group, a boutique investment management firm in Southeast Michigan, right about there. There's an idea that came out of DC earlier this year that was dumb, even by District of Columbia standards. The idea, of course, that I'm referring to is the proposal that made its way around that only now am I getting to. And to be fair, it's been scrubbed from political campaign websites. So apparently nobody is actively pursuing it or not at least using it as a selling point to get them to vote for this particular candidate. But the idea, without burying the lead, is the unrealized capital gains tax. A terrible idea, an idea that we would all regret if it ever came to be. Now, you might say to yourself, Mike, I remember that idea. That idea only impacted the ultra wealthy, and the idea there was to get them to pay their fair share, right? Because everybody knows the wealthy don't pay taxes. Now, that's patently untrue, but let's discuss that for a second. I don't remember the details, but I know that you had to have a fairly high net worth in order to fall under the jurisdiction of this unrealized capital gains tax. Now, that net worth limit, I can't remember what it was. Maybe it was 40 million, maybe 100 million, maybe 400 million. Regardless of what it was, it will eventually impact everybody, not just the ultra wealthy. Now, first, a couple of problems, right? One, how do you calculate net worth? Because usually you include things in your net worth that don't necessarily have a very clearly defined market price. If your net worth were, consisted of shares of IBM, well, that's very easy to figure out what your net worth is, right? You go on your favorite finance website, look up the ticker symbol for IBM, boom, you can see that it's trading at, XYZ dollars per share. Perfect, easy. Nobody's going to argue about that. If you were to sell shares of IBM or buy shares of IBM right at that instant, you know what price you're going to get. Now, what about things like privately held businesses or real estate transactions, or real estate in general, not just transactions, or artwork or sculptures, things like that, things that have prices but are subjective and are subject to wild swings based on market conditions and a lot of other factors. That's something that you're not considering. And if somebody's right on the cusp of either being or not being eligible for this capital gains tax, unrealized capital gains tax, you can bet that they're going to pull out all the stops, including hiring people that can help them pay less in taxes by giving them valuations on their businesses or artwork or real estate holdings that are less, that would bring them underneath the threshold. That's the first issue. The second issue is, you might think, well, even if it's the low end of their range of net worths that you talk about, 40 million, I make not that much money. I'm just a regular Joe. I'm never going to have a net worth that's that high. I don't have to worry about this. Well, that's not necessarily true, and I'll tell you why. The government keeps spending like a drunken sailor, and that means the value of the dollar keeps going down. And when the value of the dollar keeps going down, you need to make more money in order to maintain the same standard of living. And additionally, and that's inflation. We're seeing that already, right? You go to the grocery store, you're spending a lot more money for the same amount of goods and services that cost a lot less 3, 4, 5 years ago, right? So that's one thing. The other thing is no government policy or no government program, especially if it's a revenue source to them, ever stays limited. I'll give you an example. In 1913, the IRS, at that point, well, it might not have been the IRS, but the government created the first income tax, right? First permanent income tax. Now, what rates were they paying back then? Are they comparable to the rates that we're paying today? No, absolutely not. The lowest income tax rate was 1%. So can you imagine making $100,000 a year and only having to write a check for $1,000 to the IRS? That's a pretty good deal. I think anybody today would take that. The highest income tax rate back then was a whopping, staggering 7%. Now, that was only for the ultra high earners, right? Anybody that made $500,000 plus. Now, $500,000 is a decent income today, right? Can you imagine what it was back then? Well, I've done the math for you. The 2023 equivalent of making 500 grand in 1913 is like making $15.4 million. So you're talking NBA salary kind of levels, right? Professional athlete, top of their game, mega movie star kind of people, right? Those aren't salaries that you're getting working for mom and pop at the hardware store, right? But look at what inflation has done to the dollar. In today's dollars, you only needed 500,000 in 1913 dollars to be the equivalent of 15.4 million in today's dollars. Now, don't think that that's not working against you. Depending on how high the inflation rate is, you could reach numbers, similar to that or much worse than that if the government continues printing money like drunken sailors. And believe me, there's no sign of them stopping. Spending will continue until morale improves. And that's something you have to think about too. It may not impact you today, but pretty soon, with all of the spending that's going on and inflation going the way that it has been going, we're all going to be millionaires, but our standard of living will not be any better. Okay? It's like the Fight for 15 crowd found out, right? Minimum wage is like 750, whatever it is. But effectively, the real minimum wage, if you actually try and find a minimum wage job at McDonald's or wherever else, all of those places, at least around here, are paying $15, $16, $17, $18 an hour for folks without any experience, okay? Inflation has basically made 15 or 18 the new 750. The Fight for 15 folks got what they wanted, a $15 minimum wage, but with prices going up, they can't still afford to buy a car, a one-bedroom apartment, or whatever else that their hearts might desire. So that's something you have to look out for. Now let's look at a couple of examples, okay? Let's talk about realized versus unrealized capital gains. The current system is one of realized capital gains. You buy something for $20, some time passes, you sell it for $100. You've now made $80 in profit on that transaction, right? You get your $20 back, you get the additional 80, put that in your pocket, right? A little more time passes, and now the IRS comes knocking, says, hey, we saw that you made $80 last year. You owe us 25% of that. Let's just keep the math simple, right? We're going with 25% capital gains tax rate. That means you need to write a check to the IRS for 20 of those $80. So you get your 20 back, you get to keep 60 on top of that because that's the appreciation, and 20 goes to Uncle Sam. That's their 25% cut. Easy peasy. We understand that. It's simple. We've been using that system for quite some time. And to the extent that we're happy about taxes, we're pretty happy about the way that works because we all understand it. It's intuitive, right? Unrealized capital gains using those same numbers would be exactly the same. The only difference is when you bought for 20, you don't actually have to sell at 100. In fact, you don't have to sell at all. That's what makes it unrealized. That gain is only on paper. It's a figment of your imagination. It's cash, but in name only. It's not in your pocket, okay? It is on your statement, but you know that by the time that statement comes to you in the mail, that $100 might not be worth $100. It might be worth 105. It might be worth 95. It might be worth 5. It might be worth 0 if the company goes belly up. So that's something that you have to think about too, right? You're in a position where now you've got to come up with a 20 out of your pocket on top of the money you spent and have invested in order to pay off the IRS. What happens if the very next day the value of that goes down? Is the IRS going to give you an immediate refund? Or maybe you get a credit on next year's taxes, but let's say you don't have any gains next year. So now you've just given the IRS a loan for 2 years, maybe 3 years, maybe 4 years, maybe longer than that, depending on what you're invested in and how much you're earning on those investments, right? And of course, you'll have to read the fine print because it may be, it might cancel out some gains, but not others. The devil's always in the details with those types of things, right? Now, you might say, Mike, why are we talking about 20 bucks? 20 bucks is 20 bucks. I could find that in my couch cushions. It's no big deal, right? Well, ramp that up. Make it 2,000. Make it 200,000. Make it $2 million, okay? Let's look at a bigger example, right? Like, let's say you bought a house for 200 grand. Some time has passed, the neighborhood has improved, the school district got their stuff together, you made some improvements to the house, you added a bathroom, an extra bedroom, maybe added, a shed in the back, a nice fence, your lawn is well maintained and nice and lush, and now the house is worth $1 million. Combination of factors there, right? Improvements to the infrastructure of the neighborhood, all of that, but also inflation has pushed the value up. You now have to come up with $200,000, using the same percentages and same numbers, just with more zeros at the end from our earlier example. You have to come up with $200,000 to pay the IRS to get them off your back. Where are you going to get that money from? You, like most people, probably don't have 200 grand just sitting around waiting to pay the tax man. And even if you did, you'd probably rather spend that money on things other than taxes. Now, the reality of the situation is you're forced in a situation to make bad choices, right? Bad financial choices, bad life choices. You either have to maybe take out a mortgage. Now, what if you don't qualify for a mortgage? Maybe your credit's not that great. Or maybe you do qualify for a mortgage, but interest rates are through the roof and you can't afford the payments because now you're retired and you're on a fixed income. What do? Well, you're forced to basically sell the home at that point, cash in or realize the $1 million value of the home, pay the IRS their $200,000. Now, keep in mind, you're forced to sell the home, and the IRS doesn't like late payments. So you're on the clock, right? So you might actually take $950 for the home instead of the full million, thereby adding $50,000 basically to your effective tax rate because the value of the home is $1 million, but you sold it for less. Who knows how that's going to be adjudicated, right? This is just a nightmare for the court systems, but that's something to consider as well. Now you've got to buy an $800,000 home. Let's say even if you got your full million out of it, now you got to buy an $800,000 home. And if you want the same neighborhood, the same school district, all that, that's going to be a smaller, less well-maintained home, or it's got to be in a different neighborhood, right? Because now you've got only 4/5 of the same amount of money with which to play with to buy a new residence. And that process could repeat in the following year and the year after that. It's unlikely to, but with inflation, and infrastructure improvements and just, valuations being what they are, who knows who's valuing these things. This is something that you have to take very seriously. Where are you going to get that $200,000? And the same is true, not necessarily with a home, but let's say you have a privately held business. You're selling widgets, right? And you've poured every penny that you've made in the last 10 years back into this business. You're barely paying yourself a salary. And that business goes from being worth $2 million to being worth $10 million. Now you've got to come up with $2 million to pay the IRS. Well, what do you have to do in that situation? Well, now you have to either sell off part of the business, take on investors. I mean, this is all a scheme designed not to be able to build generational wealth and to take from those that actually do and can create and give it to those that can't or won't. It's a redistribution scheme, as most government is. So that's something you have to think about as well. We touched upon this briefly in the previous example, but let's say we're going back to the $20 to $100 stock example, right? You're forced in that case to sell a security in order to raise the money to pay the tax bill. And, $20. Okay, but let's say it's 1,000 shares of that. So now it's not $20 anymore. It's $20,000, right? If you have a particularly hot stock that did that over a short period of time, everybody got in at 20, and then before the end of the quarter, it bounced up to 100 because, it got some new government contract or something, let's say, right? Now everybody that owned that stock at the beginning of the year has that massive capital gain that they have to come up with. And if they're all big shareholders, or there's enough big shareholders that don't have the cash on hand available to pay that off, they've all got to sell at the same time at the end of the year, right? Which is going to depress prices. So you're in a situation where you bought for 20, you were forced to sell, or let's say you weren't forced to sell, you still have the unrealized capital gain, right? You held on at 100, but a whole bunch of other people were forced to sell, driving that stock price down. So you pay taxes on the full $80 gain, but the day after, right, you're still holding it, but it's only worth $60 now because it had a massive sell-off, people selling in order to pay the tax bill. That's a real scenario. You've now paid taxes on something worth $100 that's only worth $60. You've overpaid your taxes. So we're back to that situation. It's a horrible, untenable policy. It will fail. It will not be limited to the ultra wealthy because they're smart, or at least they can hire smart people to help them avoid paying taxes like this. It will continue to adjust downwards as inflation continues to make everybody richer and richer until those two numbers collide. And we've all got a net worth at that point of $40 million, and we're all subject to the unrealized capital gains tax. And more people that are the ultra wealthy that were being targeted initially are going to move their businesses, move their real estate holdings, move their primary residences to the Caribbean or to Ireland or to other places with more favorable tax status. And the government is never going to raise as much money as they think that they're going to raise with this tax. It's going to impact lower and middle class people much more so than anybody ever thought. And nobody's going to really be happy with it because even the rich, they can afford to move to Turks and Caicos or wherever the case is, but they'd probably rather stay in Miami or wherever they're headquartered, right? So this is a policy that can never see the light of day because even though it may not affect you today, it will affect you at some point, or certainly your kids or grandkids, when inflation takes root, when the policies don't raise as much money and they have to lower and lower limits until eventually it impacts all of us. So if you want to see more videos like this about the rich paying their quote unquote fair share, or other takes that I have on economics or government policies or proposals, please hit the subscribe button. Give me a thumbs up on the video if you like what I had to say. If you found this information useful, that's good. That lets me know to keep pumping out videos like this, and hopefully we can make this a regular thing. Until next time.